like this morning, first objective sessions, and this session 4 has 2 parts. We will leave part 2 for tomorrow morning, and then we'll only do part 1, which is risk identification and the assessment. And then this is where we'll start bringing, as you may recall, the 2 other concepts for this seminar, which is the one on the PPP and the one on blending. And hopefully with this presentation, you will see that both will naturally come from the presentation, and we'll see how important these concepts are for us. Then first, we'll discuss the key risks associated to renewable energy. And for each of them, we will have a presentation of the risk, a presentation on the way we measure such a risk, and then as a financer, and as Mustafa said, I should always remind us that we are taking the lender perspective. From a lender perspective, how would we mitigate such a risk, having listed all of them? And then comes the question, how do we best allocate this risk among parties, public, private, and whoever is a stakeholder in the project? And then finally, we'll discuss or focus a bit more on PPP. Now, if we speak about risk, it's interesting to really appreciate that you have risks which are associated to any kind of infrastructure project. Funny enough, by the way, Demba's presentation later is a risk which is very common to any infrastructure project. You have a loan in a currency and you have revenues in another one. I guess it's part of any investment. The same apply to interest risk and to operation and construction. But then you have risks which are typical to power project within the infrastructure family, and here this is all about offtake, and as we saw this morning, market and competition within this power market. And thirdly, you have risks which are typical or specific to renewable energy projects. Then the one on intermittency, grid integration, and what we call natural resource availability, which is the wind, the water, or the sun. Interesting for us, in particular tomorrow, most of these risks are in fact quantifiable and could be modelized and using historical data on technical studies. And what we'll be doing tomorrow, we will together build a financial model using all this data regarding each of the risks and try to assess the impact of this risk on our project on the return. However, if there are risks that you could quantify or measure, there are risks that sometimes you can't predict, such as political unrest, force majeure, and we have to somehow appreciate that these risks are then difficult to model, although they affect the project viability and the investor confidence. However, tools such as insurance or contingency could help. But basically, the message here is that you have the risks that you could quantify and that we will modelize, and you have a few that you have to still list as a financer, where you will somehow accept and tell your management that unfortunately, political risk exists, but it's for management to decide whether you invest in a country or in another. As I said, we will now go through all the risks, starting with those which apply to all infrastructure projects. Then we move to power project, and then we move to renewable energy project within the power project. Let's start with infrastructure project. Then, like any project, infrastructure project, will have a construction risk. And what are we talking about here? It's delays in the construction of your plant. cost overruns because of more expensive material, labor, or change in the client scope because they decided to move the location or to expand the facility. And then you could also have an issue with in relation to the performance of the plant, which again will be treated as a construction risk. Now, as a financer, again, lender, what will you be doing in order to mitigate that risk? First, you will ensure that your client has an appropriate contracting strategy. Still, for renewable energy project, contracting is not that complicated in the sense that you source PV panels from abroad. Now, the risk will still be in the interfaces because you might have supplier A for your PV and supplier B for your inverters. You want the two to be compatible and to be delivered at the same time. Otherwise, the plant won't be in operation in the right amount of time, and it might even not be performing as expected. Second, you want to have a competent developer and contractor. It goes back to you having already worked with a developer and having ascertained that it's a good one with a good track record, or at least check that they have already done one plant in another place. Then usually you will also call on external advisors to confirm that these conditions are met, and those that got the right knowledge confirmed it. And then you will have to pay attention to how the plant is delivered and completed, and have the adequate warranties on recourse, such as a performance bond, which is an amount of money put aside in case the plant is not delivering the expected results. In financing terms, what will you be doing to cover that risk? You will first build an adequate amount of contingency in your project cost. You will have a phased approach, so to make sure that you disburse alongside the deliveries of the equipment, again to cover your risk. And it goes back to what Demba will present us, but then you will expect the sponsor to provide you with a completion report, because that one goes, completion support, sorry, goes together with the currency risk during construction. We'll see later. The same sponsor might be called to support that one. And then you have sufficient buffer time between when you start generating your revenues in your financial model vis-à-vis when your plant is supposedly operating. Don't have a scenario like you have forecast the plant to start operation 31st of December, and in your model you start 1st of January, because you only have a few hours left, and if you have some delays, the whole financing structure doesn't work. And then regular monitoring, again, you call on technical advisors to check that everything is performing well. Now, the next one, again, typical for all infrastructure projects and nothing specific to renewable energy project, which is operation and maintenance. Then the overall risk, funny enough, is not that high in renewable energy project, in particular for PV, on maybe the same for wind, in a sense that you are only using off-the-shelf equipment that are delivered in a large quantity. Then you could easily check whether these equipment are good or not and how they're maintained. The only thing which is this time typical for renewable energy project is that you might have many developers and sponsors with whom you are working who are not yet familiar with O&M but want to do it themselves to save on the money. Then you have to just make sure that you are working or you are proposed a reputable third-party company for O&M, and if it's in-house, to check if they are really capable of doing it or not, because there might be a temptation to save money here, but it entails some risk. And then in terms of contracting approach, make sure that the scope and the duration of the O&M contract matches obviously the term of your investment. Now, this is the point I was just mentioning. You would like to make sure if your partner or your sponsor, the developer, is suggesting to do themselves the maintenance, make sure at least that they are sending you an annual report so that you could monitor the performance of that contract. And if there is any deviation, you should have what we call a step-in right, whereby you step into the O&M arrangements and you say, look, you are not performing well enough. There is too many PVs or PV panels which are broken down and not replaced. I want to force on you a third-party supplier because you are not capable of doing it. Then very important to check, because again, key message here is that in renewable energy, a lot of people will force you the idea of doing themselves the O&M. There might be a temptation to say yes, but sometimes an external supplier or contractor will be better qualified than area of things. And then DEMBA is not supposed to look at this one because I look a bit stupid. There's only one slide, and you prepared, I don't know, hundreds or a few hundred. Yeah. Then anyway, then exactly. I will be quick. Then, from a kind of narrow perspective of a former banker, I used to look at it really in two phases: before COD, which is commencement of operation date, and after. Basically, the risk shift and changes. The reason is that during the construction, your mismatch or the issue is between what? Between the fact that you have, or your client has a contract to supply equipment in a currency, euro, dollar, and your loan is in another currency, euro, dollar, whatever. Then here the mismatch is really between who you have, or your developer has to pay, on the currency of your loan. However, after COD, the mismatch is different. It's between your source of revenue and your loan currency. That's why we might take different approach, and we might call DEMBA on TCX, kind of free advertisement, in order to get a support during that period, but not during the first one, because you might have a sponsor better qualified to address the mismatch during construction, and then some hedging or financing product better suited for the period after COD. The same in terms of interest risk. Then how do you hedge it, and for which amount? Again, this was more typical to EBRD on IFC than interest risk exposure in local currency was something we never liked, and depends of your bank on how you approach local currency. However, for hard currency, there will be a minimum percentage of exposure to be covered. But in that one, there is no final say or final approach to it, except that the tendency when interest rates were quite low was to say that there will be a benefit to fix everything, to enjoy very, very favorable conditions. Some things that will change if interest rates increase. People may say, might not be the right time, maybe interest rate will go down, might be. But in summary, a substantial amount of the interest rate exposure should be covered in order to be safe and to have no exposure to any unforeseen event that may affect your interest rate. Then, in summary, you remember we got this question: what will you be able to assess with your financial model, because not all of these risks are quantifiable. And then among all of them, construction risk is quantifiable, and you could modelize the consequences of cost increases or delays, and we'll use the financial model tomorrow to see the consequence of it onto our project. The same for the operational risk. You could modelize easily an increase in the O&M contract cost. On the financial risk, clearly, you could play with your model by assuming an increase in the interest or any currency fluctuation on the consequence it could have on your project. Now we move from infrastructure to power.
Maybe we just ask first. I know it was after lunch. It's anyhow more difficult also after the jet lag, but just maybe before we switch to the now risks which are more related to renewables, to just ask back.
One question about the risks. I think that one of most important risks is also the track record of the developer, which is can overcome many of those. And also, if I go one bit beyond that, is also the fact that if it's a loan for a project or for a corporate, because we are talking here about project approach. Okay, but even if the project approach, if one of the shareholder of the project could be SPV, if it's with Total or Exxon and with Junior Enterprise, it should be the same. I think that's maybe the track record is also something important to look at.
It's very right. First, I should have again remind everybody that we are taking the lender perspective, and we're also dealing with IPPs and SPVs, which doesn't prevent large operators to also be the sponsor or the developer. And to take Mustafa's question, I don't know if you got the same, I would say, record or experience with this large developer, but I found two criteria very important. First, the old one, which is to say, look, these guys have deep pockets, and if there is a shortfall, they will be coming with money. But beyond that, these days, reputation is possibly even more important, because this one has a value that could affect the sponsor shareholding on value on the international market, and also credibility. So in fact, the two plays very, in a way which is very important, with possibly over time, because of the way the information is shared among all of you. By the way, your group is already per se a good example. If Mustafa here about Total not being as good as what they used to be, everybody will know about it. Beyond their track records, and both are important. The fact that they have resource, money, and their reputation. And on the top of it, obviously, if they have built a few plants, they should be able to develop others. Might be, and again here, I will be interested to hear your views. There is still one thing that somehow put me in a kind of not difficult situation, but one has to still consider it. With the development of PV, it's true that a new generation of renewable energy developer appear on the market, which grew in a couple of years. And then, shame on me, you see youngsters, meaning younger than me, people coming, being 30 years old, and maybe leaving tomorrow, because this is the way all the youngsters move from one company to the other. Then what I used to be exposed to, like the gold, all good old-fashioned utility, with people coming with grey hairs on building on the experience, on having done thousands of things, disappeared. Then how much knowledge have this new company that were built in over a few years? How much expertise or experience do they bring you when they propose or offer to build a new plant in a new location? I think that one change over time, clearly. I mean, take Aqua as an example. What were they 10 years ago? Nothing. What will they be tomorrow? No one knows. That one changed a lot. If you remember AES or EDF, or I mean, clearly different players have emerged over time.
one point on this. It is important, but because I think that's one also that the challenges of the renewable sector is that we don't have big companies. We don't have majors. I mean, if it's when you have we have only juniors companies and with very limited track record, it's less than 10 years. So it's also one the challenge that the sector is facing. Maybe in the future, Aqua will become a major, and in this case, they can take a lot of risk, but it's not the case so far. So I think that we look at the power sector, we have a sector which is the usual one on the fossil fuel. We have mainly majors, companies, while in renewable energy, we have still only juniors.
I remember because I just happened to have met him a few times. Those of you that may know Moratoglu, who created initially the kind of first renewable energy projects in France, and then sold it to EDF, and then created another one, and sold it to Total, if not mistaken. And he explained to me one thing, that he said, look, if you would like to build small renewable project, you don't do it on a kind of project finance, you do it on a kind of corporate basis. Then he was coming with its own funds, then he was providing seed money, raising the loan or the funding at the holding level, creating some separate legal entities that were not in charge of the financing. He was packaging the whole thing and then selling 100, 200, 300 megawatts to a major. As a way to help them build their renewable activities, because large companies, as Mustafa was saying, are struggling. They can't compete with the dynamic of these young, dynamic new entities that get project one after the other, at the risk of you investing in structure which have a very limited track record, and it's more faith than evidence. At the time you evaluate the competence of this company. Okay, then now we move then to, you remember, infrastructure, now power, because there are risks which are clearly typical to power sector. And then we start with the offtake. We already spoke about it this morning. In fact, you remember it's about who is purchasing the electricity. And don't forget it, you have two mechanisms usually for renewable energy project. You have the payment for electricity, but you might have also subsidies coming from green certificates or from anything associated to clean development mechanism. This payment might be done by a different party to the one that pays for electricity. Hence the idea of checking both. Then you have different parties on stakeholders that will influence the payment to you, you being, or your entity being the one that sell electricity. The counterpart could be state-owned companies, corporates, and people in charge of the market, and regulators. And now what is interesting is that we will see, I think it's the first introduction to this concept of PPPs, who is who. Because you could see that in certain markets, you're already dealing with the public sector because they are the off-taker of your electricity. In other, you will have private off-takers than private parties, but anyhow, regulators and transmission company will be considered as public. They might be private operating under a license, but they are regulated in spirit of a public party. Then the summary of that slide is that beyond the off-taking arrangements is that public party are always part of renewable energy project or power project in general. There is no way to avoid them. Then now, when we classify the risk, and I think it built on what we discussed this morning. You remember when we spoke about the benefit of categorizing all our projects through a methodology, is that these methodologies that we have seen also apply to this idea of comparing and classifying projects to check their performances into a category. Then you have to compare apple with apple. Then the idea will be, through my methodology, how do I assess all the project based on PV. And then track record, PV suppliers, equipment. But the same could apply. What is my experience as a lender in operating in category A project? You remember those where you sell to a third party in a kind of take or pay arrangement with no risk. And again, people from your risk department, but also those who are working on the balance sheet of your bank in terms of provisioning and compliance will be very interested by your methodology, because then you could extract from your portfolio all the projects which have similar feature and build a track record. The off-take risk, what is important that you could not fully mitigate that risk, and one of the way you will overcome that problem is by adjusting your pricing. You remember the category A, B, C, D, E. We will see them again. How ultimately would you decide to invest? Might be the risk is higher, but my margin is higher as well. Then you will somehow strike a balance between the two, adjusting your return to the risk profile of your project. In reviewing the different off-take arrangements, you will be looking obviously at the price, then the settlement, dispute resolution, and you will take particular attention to the PPA and some clause of the PPA, such as the take or pay or any constraint associated to the volume. The tail, we will go back to the tail later, which is the amount of time left between the end of the loan repayment and the end of the PPA. And you remember, Mustafa spoke about renegotiation of a PPA. If you have a tail, you know that you have a buffer whereby you could extend or renegotiate your loan, extend the tenor, so that the lender could afford the repayment within the term of the PPA. Then it's providing you a huge recourse on security. Obviously, the delivery point with a typical, I would say, negotiation on game in between your developer and the regulator or the network operator, whereby the trick will be, are you delivering electricity at your fence, meaning just outside your plant, or at the substation? And as you could appreciate, the big difference is that regulators will always try to shift on you the responsibility associated to the power plant and the substation, so that in case of any issue associated to curtailment, issue of volumes, because you are delivering at the substation, they may say, sorry, it's not my fault. Then there is clearly a very important consideration to be given to where you deliver the electricity. Is that just outside your premises or at the end of the line, putting on you or shifting on you part of the responsibility over the line on the substation? On the penalties for non-performance, particularly true when your regulator needs the energy and you can't deliver, then they might penalize you if your plant is out of operation. Guarantees, and we will see that later. The way we will structure the financing will help, because of the nature of the financer, cover part of that risk. No need to go again through that slide, but the same principle as the one we described. You remember all the categories of project that we will be using in order to associate each of them to a certain off-take arrangement, and then we put them in a risk profile matrix, as we will see later. Now, competition. And then this is where it's still power, but we need to make sure that our plant, could it be conventional, could it be renewable, is competitive vis-à-vis other supplier. In an open market, as you could appreciate, open market means that you are selling against everybody. It's critical. Then you must be the cheapest one, otherwise nobody will buy your energy. But still, if you have an off-take arrangement which is more or less secure, you have to take a view whether on the short or medium or long term, your energy remain competitive. And it goes back to the example we were giving this morning. If you have a PPA under condition of take or pay with a feeding price, I think I'm using all this terminology, but you are familiar with them, which is far too high. It used to be right 5 years ago. Now it's out of market. You know that you are at risk. Not that somebody will somehow pull out from the contract, but surprise, surprise, you might face some difficulty in the dispatch, and you discover that dispatch was your responsibilities. And there is many ways to make sure that somebody which price is totally out of market is not dispatched. Then you will still, irrespective of the impression you have that you have a very strong legal agreement, make sure that it's backed by economics evidence that confirm that yes, you are good and you are cheap. In order to assess competitiveness, we have also to look at the way prices evolve. And here, James already proposed interesting chart that show the price of PV panels, if not mistaken, over the time. But James was tricky, like always, I know, because tricky James didn't speak about a cost of financing, and we'll see where tricky James is tricky. Then, initially, price of renewable energy was high, and this was very much, James' point, high capital cost, low capacity factors, then the panels were not of a really good quality, and intermittent nature of production, that one has changed. It's still the same. And then we saw the price going down and plummet down due to the tech, which was clearly improving. The financing costs, as you might remember, were very low, and we'll see that just in the same slide. And then we had surely a regulator, I call it leniency. In fact, regulators were either incentivized or pushed to accept more renewable. And then they almost accepted, I won't say any kind of productions, but kind of. Then you will be coming with a solar power plant or a wind farm, which is not very well located, which production is very intermittent or not good, but still, government said X megawatt must be installed in that given country, then please regulator dispatch. This was good up to a certain volume of renewable. And when you reach a volume where regulators say, look, sorry, I have a base load, I need to supply customers, I can't accept any longer more renewable. And then you've seen what happened with overall price that increase. Why is that? Because you had an increase, and we'll see that just after in the cost of funding. The subsidies reduced. People say, look, there is so much competition, I don't accept any longer to pay an extra fee for getting renewable, famous feed-in tariff. And regulation was strengthened with I guess you are all exposed to this new tenders for new capacity of renewable, where now solar projects are called with batteries. And as you can imagine, it's almost doubling the price, because now regulators are saying, sorry, I can't dispatch any longer without having a buffer capacity with my renewable energy. Now, I try to build just a kind of scale in terms of timing, and if you add to this slide the way the 20-year AAA bond, which gives us a rough indication of the price or cost of money when an entity like World Bank, EBRD and Co. Is issuing a bond. What is very interesting is that cost of funding has clearly seen a drop. It was even below zero at 20 years. And now we are back at what we knew like 15 years ago. And the fact is that renewable energy got cheaper, but many people not confused, but forgot the thing that this was also largely due to the cost of funding. Yes, technology, but funding, yes, as well. Plus, and this is something which is changing, competition among financiers was huge. It remained very important, but it's not as important as it used to be. And this will have an impact on the overall cost of our projects. To be always smarter, we will have to try to assess the competitiveness of our plant based on indicators, because now we spoke about general thing like economic trends, but now we have to look at our project and try to, when we look at the competitiveness, try to understand what are our competitors doing and how we position ourselves. So now we will have to first look at the price of our electricity by being sure that we don't forget anything, either or not some implicit economic upside on something that come like a disguised subsidy. So to make sure that when we assess our price, we compare again apple to apple, and we are not exposed to a big surprise where we say, oh, we were cheaper, but in fact I didn't realize that, yes, we did have a subsidy that now disappeared, because that one will change completely our calculation. The key parameter is what we call the levelized cost of energy. That is somehow representing the cost at which our plant is producing. Tomorrow in the financial model, we will see how we build and we calculate that figure, which is possibly for us our key indicator. By the way, that one is not specific to renewable energy. It's true for any power plant. And now what we'll try to do, it's to, having done this fancy calculation, which is not that fancy, but we'll do that tomorrow. What we'll try to do is to compare that cost, levelized cost of energy, then it's a cost at which, in average, we are producing energy with our power plant, and it take account of the cost of financing. But now, obviously, we have to compare it to what? To the price at which the power system to which we are connected is operating, and in particular, the price of the most expensive plant which is dispatched at the same time we are supplying the network. Basically, the concept is the following. You have a grid. Many plants are interconnected to that grid. Now you're interested to know what is the price at which the most expensive power plant is supplying. And why is that important? We'll see later. Is that because you know on the long run, and it includes as well the depreciation of the asset, that on the long run, if you are cheaper than this guy, there is no reason why you are not dispatched. Yeah, might be you have this intermittence that is creating an issue, but still, you are coming at a kilowatt hour, let's say at 5 US cents per kilowatt hour. This guy, LMCR, is coming at 6. There is no reason why you are not dispatched, because you are cheaper. That one is the ultimate protection. And then you have to calculate it for the next year, or the next 5 years, or the next 10 years. So again, that you forecast the way the network will be able to buy your energy. Another figure is quite interesting. It's the same one where you discount and you take out the depreciation of the assets. Basically, here you are only using OPEX. Then a typical example will be a CCGT, then a combined cycle gas turbine, which will be your main competitor. Why is that? Because they are very flexible in terms of ability to produce when the demand is coming. And then they have an ability that you don't have, is that they might be able to only charge for the gas and to delay the depreciation of the assets or the repayment of the loan. Then if they want to undercut you and produce and send a huge volume of electricity, they might be producing at that cost. They can't go below because they have to pay for the gas and the maintenance. However, they might delay the depreciation. Mustafa example about, for example, big corporates, guys like AES, name them, or EDF, or whoever, might be able to postpone the repayment of the capex or the repayment of the loan. What they can't do, obviously, it's to produce at a cost which doesn't include the price of the gas. They can't. But then that price will give you an indication whether you are far or close to the minimum of your network. And this is very important to do, to again come back to your credit committee or equivalent by saying, look, you know what, we are expensive or we are cheap, but we are reasonably cheap or reasonably expensive, because this will translate into what risk you are taking. Another fancy way of considering or calculating your break-even price of a power plant, tomorrow we could try that one, it's to build your financial model and to force a DSCR at 1. Then what is the bare minimum I need to generate in terms of cash flow in order to be able to afford my loans? So this could be another way for calculating your prices. And then what we will be doing, again, it's a reminder, we will have to make sure that we compare apple to apple. Then we have to compare our production price, net of subsidy, with the others, because subsidy might disappear. Now, if you have a subsidy which is forever, good for you, you might re-include it. But there is a risk to the subsidy and the need of comparing exactly the same price when you look at your competitiveness risk, so to make sure that you compare everything. You have, again, also to make sure that you include transmission distribution cost, the same way, VAT, other levies, and then I guess this is a similar concept as the one I just described. We will have to describe it or to compare when you don't have readily available data on short-term marginal cost or long-run marginal cost. Usually go to see the larger thermal power plant, coal-fired plant or CCGT, try to get the accounts and make up the figure, so that in absence of an economic assessment of the network of South Africa or Croatia in particular, I take Croatia because it's interconnected with ENSO, then you won't modelize the whole Europe. Take in your own country what you believe is the cheapest supplier and you compare. You are at your levelized cost of energy and you realize that you are more expensive than the long-run marginal cost of your network. And here, big problem, because it's great, you got an outstanding price, everybody is happy within the credit committee because obviously you have a nice project, but you know that you are at risk. Why is that? It's because on the long run, somebody will provide energy at a price which is cheaper than you. And this isn't good news, because if your loan is 15 years, you might be in trouble in 5 years' time. Government is changing. They decide that, sorry, your energy is too expensive, we won't dispatch you, and you will get into trouble. Could it be through the PPA or through any kind? I mean, there is so many agreements that somehow underpin an energy project. You will always find a way to challenge the project and make it in a difficult position. This is a sound project where it's perfect, it's magic, because you are just in between the two figures. And I'm honestly thinking that this is something that all you bankers should be checking before deciding to propose a project to your management for financing. Now, it's a bit less glamour what is coming, but why not? Now, we are talking now about resource risk, and as you may remember, this morning, we spoke about these probability scenarios, P50, P75, P90, on the others, whereby the number corresponds to the percentage of chance you have to produce more or less of energy. We say this morning that it only applies to those projects where you have a kind of natural resource availability, such as wind, solar, or water. And then what you will be doing is to work on a kind of probabilistic approach in order to assess the ability of your project to meet certain requirements. We will use this data to perform some what we call debt sizing and also design of financial covenant. And what we will try to do in the second part of this presentation on tomorrow, it's and this is where blending start kicking in, as you could see, is that as part of all the exercise we will have about the debt sizing, we'll try to determine the optimum blending between senior, junior, the way you could structure a mezzanine part, because this is directly related to the nature of our renewable energy project. And for instance, the fact that we have this unpredictability in terms of quantity and timing of the production. You also remember at the beginning of this presentation, we spoke about whether each of these risks could be modelized or not. Some of them could, other couldn't, and sometimes it's just in between. Then offtake revenue or offtake risk could be modelized in terms of price. It can't be, unfortunately, because it's more like a political risk nature, be modelized in case your off-taker decide not to dispatch you in a way which is a bit unfair. Then partially will we say that off-take risk could be modelized. Market risk, again, it's partial because you will extract from your model your levelized cost of energy, but it will be somehow your judgment to say where do you position yourselves in between all these prices. And here, for natural resource, we will just modelize it through this historical data when we will have a P whatever scenario and run the model with this data.
No problem. Sorry. So good afternoon to all of you, and very good, nice to be here, especially here at Proparco, because I used to work for Proparco before, and also I used to work for AFD before. So it's always a pleasure to be back at home. So I see a lot of familiar faces here. And the question for you, Laurent. In one of the, and sorry again, just to give you some background, I'm not an expert in terms of renewable energy projects. I'm mostly on the financing side. So I apologize for my probably ignorant question. You have you shown one slide where you have done these magic sounds, remember, where we all opposed you. You said when the leverage cost of energy is higher than the, I don't remember the exactly. So it means the project is not great, right? It's at risk because of the competition that might come in the future.
Exactly. Yeah, because the issue is the following: then the long-run marginal cost is somehow predicting the price of the most expensive resource, including depreciation, might be, I mean, what this entity will be supplying in terms of price. Then basically, you look at your system, you have a few existing power plants, and then you look at all of them, and the most expensive one, including depreciation, will be that one, and it will give you a price per kilowatt hour. If your renewable energy, like it happens very often in renewable, because of the incentive mechanism is higher, and it was the case in France, where you will be offered the 12 euro cents per kilowatt hour, when the long-run marginal cost at generation will have been 6. Then how long the difference will last for? Or for how many power plants? Because it comes a time where it's not affordable for the system.
So it means then for the people who need to decide to proceed to that project, yes or no, they need to take a risk.
Exactly.
And it means if you are very conservative, you will never finance this project plan, right?
Sure, sure.
But the demand is, the need is here.
Or the trick is that you come with AFD, or you come with IFC or with EBRD. In fact, you identify the party that may guarantee you, directly or indirectly, the fact that you will be fairly treated. Irrespective of, yes, there was a subsidy, but it's a legal commitment under an agreement signed by whoever. And if it's rubber stamped by something like, again, France SA or IFC or EBRD, you will have an increased confidence about it. However, you will never find anyone to guarantee that, because it's a nature which is above or whatever is subject to a guarantee, because it's part of an operating system. Yeah, it's not.
Thank you.
I think TCX is wanting to explore that risk as well.
I think in considering that we really want to ensure that we stop today on time, because some of you might be still jet lagged, I would suggest that we really switch now.